Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we've had a busy week. We had a fairly long econ show. I apologize for that. There was a lot of things we were trying to get across and answer some questions that we had in the comment section. But now we're getting ready for the long weekend, so hopefully everyone has something fun planned for the 4th of July week, and hopefully you enjoy your day off. But in order to help everyone get to their weekend, let's get through this as quickly as possible. Which is what was the frac spread count for today, which was 285. So it was a drop of 4. Now, to be clear, there's normally a drop for this week just because obviously they're celebrating the 4th just as much as everyone else. So typically this is when you have a moving day, you're going to either shut things down or just you're going to use this as a period to move spreads from one area to another. But again, still right along the pace that we normally have. The drop was really driven by Appalachia. We had a little bit of a reduction, Western Gulf, Williston, just your typical one or two that have fallen. But we did get an increase in Anadarko, which was something we expected. We continue to see a lot of growth in the Midwest as well as in the Western Gulf. Now, in the insights for those that follow it, we did go through what does Freeport mean, how we still are exporting a significant amount of LNG. And yes, we're not at $8 natural gas, but we're still at over $5. And for many that have been looking or working in natural gas and have gotten used to $2.50, $5, over $5 is still a very good place to be. And it's why we expect to see a very continuous and movement when we're looking at activity in the natural gas basins, just as much as we're expecting to see the stability in the oil side. Now, we had a great comment from Twitter on last week, when they were somebody said that you get more activity because you have more issues because of the heat, especially when you have some of the stacked transmissions, some of the stacked activity, which obviously is 100% true. And that's one of the things that I just wanted to highlight. When we look at our expectations for production, for activity, we're always factoring in weather, which is why we talk so much about seasonality, because you typically get an increase in completion spreads just because you need more activity to maintain your current production profile, which is so important because, again, this is guidance. Everyone wants to hit those key numbers. And plus, with where the price deck is, which E&P doesn't want to try to capitalize on where pricing is right now. So that's why we will continue to see this activity. And to the individual's point on Twitter, some of the equipment coming back isn't all that great. So again, that's also going to result in some more breakdowns and some additional capacity coming on, which is why we do still see getting to about 300 spreads as we come through, which at this point is going to be 15 spreads. But realistically, it's closer to a 10, 11 as we get to the end of July. Now, when we start looking at the rig count to more drilling, and for those that are on Twitter who know who Moore is, more to his chagrin, the rig count did come down by 3. But let's break it down. Directional did go up by 2. Horizontal dropped by 3. Vertical dropped by 2. This was driven by gas. Gas fell by 4, with oil coming up by 1. So again, you're still seeing that movement. You're still seeing the activity that Louisiana picked up a rig. New Mexico picked up a rig. But again, it is July 4th weekend, so to see some slowdown on the rig side after seeing some very prolific growth, it's not surprising to see a little bit of an adjustment when we're looking at what is happening at this point in time. But again, we do expect to see that snapback as we go into next week. Now, when we start looking at the global market, I think it's important to look at how things have shifted and where OPEC is right now. So when we look at West Africa, Angola actually overtook Nigeria as the region's biggest exporter. It's happened before during some downtime. This is a mixture of two pieces. One, you had the Libya hiccup, which we'll talk about in a minute. in terms of the loss of exports, so that caused people to scramble, especially in Europe. Angola is fairly close to the Libyan crudes, and is an easy swap. So again, that's also pulled in a more Angolan versus Nigeria. Nigeria had some other production issues, but they've also were fairly elevated in pricing. And now, for those that watch the EIA show, we were talking about Chevron, and they're trying to move of the Usan cargo, and they were finally able to move it at $1 below dated Brent. So again, they kept moving that down. So that should bring pricing down a bit in Nigeria, which will accelerate some of those movements as we head into July, as they try to move things through. But now when we start looking at what exported, where were exports during some of these key areas, when we look at for OPEC, and you can see that there was a drop from May into June, from 3.44 million barrels a day to 3.38. And this is a mixture of, again, Russia. Russia is pulling in a significant, is sending out as much as they can. India and China are pulling down as much as possible. But you also have slow buying from China, and we've seen that continue to walk back. But in July, we have so far seen a steady pickup in European buying, which we think is going to remain a bit elevated. So even as China slows their West Africa purchase and Asia slows some of their West Africa purchase, we'll see some of that getting shifted into the European markets. And this will pull down pricing just a bit, but again, we will see some of these movements. Now, to put the Chinese slowdown in perspective, here's where you can see where we are versus 2020. We're down to 71 cargoes, which is low for this time of year, as we are usually starting to ramp back up. But because, as we talked about in the EIA show, you have mega refiners that are operating at about 70%. Same with state-owned refiners, even as Shandong or teapot refiners are sitting at 66%. So you're seeing a slowdown on the refining side, which is reducing the amount of imports they're pulling in. And there's also a certain amount of, maybe they're not, the AIS transponders may be getting turned off if they're carrying Russian crude, to keep people guessing a bit. But again, we don't really think that's more the exception than the rule at this point. So I think this is a fairly accurate number, as we're seeing more of these movements. But now going back to our trusty chart from Stephen, here you can see that the NOCs where they've declared force majeures on all four Gulf of Sirte oil ports shut by protesters. Also force majeure on El Feel field. NOC says exports now as low as 365 barrels a day, which was 1.2 million. So this will leave Europe short, which has prompted that additional purchase from West Africa, which has been, again, as we said, a bit more weighted towards Angola. But it's important to say that this could shift at any time. We don't see it shifting in the near term, which is why Europe has scrambled to find as much as they can from the West African markets. And there's more than enough in West Africa, and that's going to keep that floating storage a little bit more reduced, and it should support a little bit more activity, or I should say flows from the U.S. Now, when we start looking at some of the updates from the BP statistical review, I think it's important and I think a bit shocking when you look at the amount of money that has been dumped into wind and solar, and still when you look at where a lot of the global economy and where energy is based off of. Coal has actually made a comeback when you look at 2022. Natural gas as well, and we do expect to obviously see more wind and solar. But again, I think when you look at this, the goal should be a more balanced basket, if you will, and less of just this target at one specific location. We need to appreciate that a large part of the country, the economy, globally speaking, is running on a lot of these different key inputs, and we have to continue to look at how are we going to address this. We can incorporate a bit more wind, a bit more solar, but we still need base load capacity, affordable base load capacity. As we talked about in the Econ show in segment 1, there is a huge hit to emerging markets, especially Central Asia, in terms of the cost of their power and electricity, because LNG prices have gone up. We'll talk about that in a minute. And those are some of these key shifts. So when we look at it, we have to really say, look, methane or LNG has a much lower carbon footprint. We need, as again, I understand that we have to be respectful when we're looking at methane, minimizing methane leaks, because methane is damaging to the environment. But when you look at the use of LPG and LNG, it has a low carbon footprint. It reduces a lot of those GHGs that you get from some of the others like coal and oil. And by oil, typically here we're talking about ultra low sulfur diesel, low sulfur diesel, and more importantly, high sulfur fuel oil, because a lot of these countries have turned to high sulfur fuel oil because they can't afford anything else. But if you make some of this gas readily available, or more available, then you'll bring things down. But there's always the caveat of where is Germany buying, where is Europe buying, and how that's stealing from some of those Asian cargoes, which we're going to talk about in 1 minute. So then when you look at the U.S. power generation side, even as we've had renewables come up, you've also seen gas continue to gain, as well as some of those low carbon pieces. And again, that's not a bad thing. It's okay to rely on natural gas because we have so much of it. It is something that we need to really embrace and look at ways that we can continue to create a sustainable grid. And by sustainable, I mean redundant, something that's always going to run, that we can trust, and we're not going to have rolling brownouts while we continue to incorporate renewables where it makes sense. But again, it's important to say that, well, can I turn some of this coal into low carbon? There's some processes that I'm working on with Matrix Energies where we have some of these solutions that we think would be prolific and provide not only be carbon neutral, but actually carbon negative, while being able to sell off some of those parts coming down. Now, this I thought was an interesting chart. Flows of Russian natural gas to Europe have obviously come down. So now the U.S. Exports more natural gas to Europe than Russia for the first time ever. And obviously it's because the more flows continue to go into the European theater, but obviously Russia collapsing the amount of natural gas heading into that country, I should say into that part of the continent, is helping the U.S. number. But it just gives you an idea of how important U.S. LNG is to the market. We did get some concerning news from Freeport saying that they won't have partial capacity back until October. That's a mixture because there's been more federal mandates made in terms of safety, so that has slowed some things down. But again, that's going to prolong some of those issues. But the U.S. is still putting out a significant amount of LNG, even as we get that reduction from Freeport, which is keeping U.S. movements and obviously helping kind of balance out the market a bit. But a lot of this is going to Europe. And as the shift goes into to Europe, that's pulling a lot of that capacity away from the Asian markets. And all the while, many parts of the U.S. continue to experience high electricity demand as heat waves continue to move through. You can see this is only from June 19th, but we've continued to see it pull through as more heat waves are expected from essentially Texas and the Gulf of Mexico all the way up and through to Montana. So that's going to keep demand moving through for AC, electricity, and help support some of the movements when we're looking at natural gas in general. So now it's important to look at, well, how are we going to replace some of this? And here you can see lithium-ion battery imports and how the imports have continued to move up. But when you start looking at the cost of making batteries, the cost of the raw materials, we've had Ford come out and say that essentially the cost of making an EV has wiped out any type of profit that they would make per vehicle. And this also comes down to, well, how sustainable? And if you look at this is just also factoring in that just what is it? I think we're at 4% EV in the global fleet. So what happens if it's 25% of the global fleet and you start to see some of the knock-on impacts? Not to say that we shouldn't make EVs available, that we shouldn't give people the option, but to force it without having the proper raw materials, the proper grid in terms of baseload capacity, will lead to additional stress on the system, which is why when you start looking at global investments in fuels, it's set to rise in 2022 as it should. And this is obviously an estimate. We do believe that 2022 investments are only going to go up based on just where the curve is, how the long end of the curve continues to shift up. And again, I'm not saying that the curve is predictive, but when you're looking at coming up with the economics of a project, it helps the economics, it helps support new activity. And we do think that natural gas is going to continue to take a lot of that market share as we are involved with more and more, not so much new discoveries, but taking what used to be stranded assets or deemed stranded assets that are now massively economic and turning them and bringing them onto market. Now, when we look at just some of the new activity from the U.S., not surprising based on, for those that have been following us, the PMI numbers, ISM PMI numbers came in well below expectations. ISM manufacturing came in at 53 versus the estimate of 54.5. New orders are now in contraction. Prices paid have started to slow, but continue to slow, but again, still very elevated. Still at 78.5, so well above 50, so still massively expansionary. But again, the pace just continues to slow. Construction spending pared back. Global U.S. manufacturing came in right near estimates of 52.7. But then when you factor that in, the new Atlanta GDP now, real GDP forecast for Q2 is at negative 2.08%. And this came out after the data dropped. So again, you're seeing more of that pressure. But when we look at the growth that was, I don't want to say there was a ton of growth, but so when you look at January, February, March, we know what happened there. There was that slowdown. But then when you look at April and May, there was a little bit of a bounce, and we still think that April and May growth will be able to kind of carry where Q2 shakes out. This to us points to, and I think confirms what our view is on Q3 being very sloppy and getting worse, because the trend has been negative. If you've been following the Atlanta GDP as we have, as we've been talking about it, it started out positive in April. It actually got a little bit of a bump higher in May. But since that bump, it has gone straight down and is now negative. And we think really supports our view that Q3 is going to be a bit sloppy. And actually, it's Q3, as we've been saying, we believe that Q3 will be negative, and right now we are moving into that recession. New orders to inventories index now suggests manufacturing activity will begin to contract in the coming months. Again, supporting our view that Q3 is the start of the recession. And then when you start looking at it on terms of the different pieces, here you can see business and employment is now contracting. Employment is contracting. New orders is contracting. Prices paid has come down, but you can see it is still elevated. It's still sitting at these levels, which again leads to our point about stagflation, where we're just really going to go sideways and continue to see a lot of that stress in the system. And then this is just looking back through the 1990s, how we've had spikes higher to these levels before, but just look at the staying power. And in terms of where we continue to have these higher lows, we continue to have these sideways moves, and you can see just how elevated it is, and staying in this level again is going to put more pressure on the consumer, which is what we talked about extensively in segments 2 and 3 of the Econ Show. So we're not going to rehash it. We'll talk more about this next week, which should have a little bit of a shorter show just because we didn't have as much data, given the fact that we had a lot of data come out this week. And then we had Canada Day today. So happy Canada Day to our Canadian followers. And then obviously for those out there, we hope you have a great 4th of July. So that's what we have for you. If you have any questions, you can find us in the comment section. You can find us on Twitter. We appreciate any feedback as well as any questions. And if we'll try to cover them on future shows if you have any requests. So thanks again for watching, and we hope you have a great long weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.